And now for a closer look at financial markets, we are joined live from New York by Laurence Schreiber, co-president of Clarity Capital. Thank you very much for being with us.
Hi, Natalie. Thank you for having me.
Hello. Well, there is an old saying on Wall Street, sell in May and go away. Since we're just at the start of June, what's the meaning behind that?
Sure. It's actually kind of an interesting thing. Many years ago, kind of the old-time traders on the New York Stock Exchange realized that there seemed to be a pattern, that during the summer months, markets might go up and down, but by the end of the summer, they were pretty much where they had started out. So they had this expression, you sell in May, go away, take your summer vacation. Obviously, it might have been a little bit self-serving in the old days when you didn't have global 24-hour markets, an excuse to relax a little bit more during the summer.
So do you think it still has any merit here?
Well, what's so interesting is the pattern has been tested over a long time, and unlike many kind of old wives' tales or sayings that get expressed, there was some numeric backing for this. People looked at a study over 64 years of the Dow Jones Industrials, and the average return of the stock market every year was 7.9%. Interestingly, only 0.3% of that average return came between May and October, the summer months, and the 7.6% of the 7.9 actually came in the winter months between November and May. But like most things, it's not that easy. And in the last couple of years, with the big bull market that we've had for the last 6 years, the summer has rallied as well. So there have been gains in the summer and gains in the winter.
Well, interesting point. So is this one of those old pieces of wisdom investors should really follow now?
Well, again, I just don't think, unfortunately, investing is not that simple. People shouldn't follow simplistic rules. One of the problems with trying to time the markets is, number one, it's very difficult. Number two, if you sell, you're going to incur taxes on all your gains that when you then reinvest, you have to make back even more to get back the taxes that you paid. And there have been a lot of other themes in terms of how markets trade. In something called the January effect, where typically there was a lot of selling in December to lock in tax losses, and then a rally in January. And unfortunately, those themes just don't stay consistent over long periods of time. So people, for the most part, should keep a diversified portfolio and not try to time markets too much. It's extremely hard.
So this isn't the only calendar pattern that you're looking at, but what advice do you specifically have for investors this summer?
So, we are at the very potentially end legs of what has been a very long and very powerful bull market, 6 years. So investors we're not saying that it's over. There still potentially could be some more to go, but investors should be conservative and diversified in their portfolios. If you had a very high allocation to equities, it's probably time to start bringing that down. And I wouldn't make your summer plans based on your investing plans. I would make your summer plans as fun and as exciting as they can be, and I would be conservative and thoughtful in your investing and probably not tie the two too closely together.
Well, thank you so much for your market tips. We do appreciate it. Laurence Schreiber, co-president of Clarity Capital in New York.
Thank you, Natalie.